Well, I have the privilege of introducing John Campbell, our current president, for his presidential address. I know many of you have dealt with John Campbell in various professional ways, and you may have wondered a bit about his background because he presents a bit of an anomaly. He has this accent. He talks a little funny, so you might think that he's British. But if he's British, where's all the sort of sneering condescension all the time, huh? Where's all this sarcastic superiority? John Campbell has this very open, cheerful, positive approach to everything that means he couldn't be English. So he's obviously a native English speaker. You might think that he's American. But if he's American, where's all the loud, blustering, bad manners, huh? John Campbell just is too gracious and too deferential to be an American. The answer, of course, is that he's both. And he somehow managed to avoid the worst and embody the best of both national groups. On his mother's side, John is all apple pie. And on his father's side, he comes from a long line of English dons, history professors, theology professors, and so on. He was raised in England, and his undergraduate education was at Oxford. And then he decided to head across the Atlantic, and he immigrated to the Ivy League. And he has since been associated with three pretty good universities that you might have heard of, Yale, Princeton, and Harvard. At Yale, John wrote his dissertation with Robert Schiller, who I see down here. Thank you, Bob, very much. That was a gift to all of us. And he's continued to collaborate with Bob Schiller periodically over the years. Now, one of John's great contributions to our field in his turn has been the many wonderful PhD students that he has produced as he's worked at these great universities. And there are certain things that they all have to learn in the course of their training with John. They all have to learn that Bob Schiller's books are visionary and important. And they learn that Bob Schiller's articles are seminal. And they learn that Bob Schiller's algebra is extremely clever. So from Yale, John went on to Princeton, where he was an assistant professor and eventually tenured and became a chaired professor. This was his furthest penetration into the interior of the continent. He views it as his time in America's heartland, and apparently it was just too much. So he had to get back somewhere where he could see the Atlantic Ocean, and he moved to Harvard's economics department, where he is now happily ensconced as the Allshunt professor of economics. To prepare for this occasion, the first thing I did was what anybody in my position would do. I went to John's webpage and I downloaded his Vita and I clicked on print. Right? Then I waited around for a while, and then I went for coffee. I always go for coffee with Stan Zinn, so that's a very good way to kill a lot of time. And then I had to come back and put some more paper in the printer. It is quite an amazing document for somebody who got his PhD in 1984. It has 8 full pages in tiny little font, books, edited books, articles, comments, notes, columns, reviews, and in addition, quite a healthy pipeline of working papers. So he is still at it. We're never going to catch up. Now, while he's been doing all this research and writing, John has also been involved in all sorts of professional service activities. He was program head of the asset pricing program for the MBR for 9 years. He's been an editor of the Review of Economics and Statistics, a co-editor of the AER, and he's been on any number of editorial boards in finance and economics. John is an outstanding professional citizen, and not just in the ways that are visible to everyone. I am a former editor. I know about people's citizenships in ways that are not very visible, and John is a wonderful professional citizen. I referred earlier to the length of John's vita, but what's more remarkable are how fundamental many of these papers have been and continue to be in the research that we are all doing. In fact, people are often surprised to find out that John Campbell did not actually invent the logarithm. There was this guy Napier back around 1600 who seems to have beat him to it, but he has certainly shown us all how useful it can be in better understanding financial economics. John has made seminal contributions to all of the major areas of dynamic asset pricing, empirical methods, portfolio theory, and general equilibrium asset pricing theory. Most notably, he's developed important empirical methods through a series of papers with various co-authors that explore variance decomposition techniques. He's helped us understand normative portfolio theory by being one of the first people to start using simple, tractable models for the dynamics of asset prices that allow us to actually solve the portfolio problem and learn something about how people behave in these situations, or should behave. And then he's developed asset pricing models through the work on external habits that have just become workhorses for all sorts of people who are engaged in our business. And anyone who's attended job market seminars in recent years can attest to this. What is remarkable about this body of work, in my view, is that John Campbell develops tools while he is pursuing substantive problems, right? Not as some sort of esoteric end in themselves. His methods become widely deployed, and his work is so influential because the tools he develops are just so manifestly useful. Right? They were useful to him in addressing whatever problem he was attending to at the time, and because he works on very central problems, people immediately recognize that they will be useful to them and get to work using them. Along the way, he is constantly teaching us new things about why financial asset prices do the remarkable and interesting things that they do. And I'm sure we're going to learn something about that this evening, so I will turn you over to John Campbell.
Well, Rick, thank you very much for that introduction. I had a fever yesterday, and I thought I was better, but after that roasting, I think it's come back. When I tell people the initials of my presidential address and invite them to guess its title, the most common answer is that my talk must be about hedge funds. In fact, I'm not going to talk about the most sophisticated actors in the financial system. Rather, I'm going to talk about some of the least sophisticated actors, ordinary households. I want to argue that household finance deserves the status of a field within our profession. Just as asset pricing asks how prices are set in capital markets, and in particular how average asset returns reflect risk, and just as corporate finance asks how the owners of business enterprises use financial instruments to further their interests, and in particular to resolve agency problems, so household finance is a field that asks how households use financial instruments to attain their objectives. Of course, household asset demands are important in asset pricing too, but there, wealthy and risk-tolerant households have disproportionate importance. And the field of household finance differs because it's more concerned with the behavior of and welfare of typical households. Now, finance research can be either positive or normative. Positive research describes what people actually do, while normative research describes what they should do. In the household context, both of these are challenging tasks. Positive household finance is asking how households actually do invest, and the challenge here is one of measurement. In the United States, households guard their financial privacy jealously. In fact, they may be more willing to reveal their intimate affairs to a sex researcher than intimate details of their financial affairs to an economist. Also, many households have complicated finances with multiple accounts at different financial institutions, having different tax status, and including both mutual funds and individual stocks and bonds. Even households that wish to cooperate with researchers may have difficulty answering detailed questions accurately. Now, normative household finance asks how households should invest, and the challenge here is one of modeling. Household financial problems are complex in numerous ways that are not well captured by textbook finance theory. Households must plan over long horizons, so changing investment opportunities are important, as emphasized by Robert Merton. Their horizons are finite, so we need to use a life cycle framework. They have important non-traded assets. Obviously, they're human capital. They hold illiquid assets, notably housing. They face constraints on their ability to borrow, and they are subject to complex rules of taxation. Now, at this point, we should pause to ask whether positive and normative household finance can be different from one another. There is a strong tradition in economics that says we know nothing about people's preferences beyond what they actually do. The revealed preference approach, dating back at least to Paul Samuelson in 1938, infers preferences from decisions and leaves no room for normative economics as distinct from positive economics. My colleague Robert Barrow expressed this view with characteristic sharpness when he told me that normative economics is what you do when your model fails to fit the data. Now, household finance poses a particular challenge to the revealed preference view. Many households seek advice from financial planners and other experts. And some households, as I will show, make decisions that are hard to reconcile with this advice or with any standard model. It is possible to describe such decisions using behavioral finance models with features such as loss aversion, narrow framing, and inflation illusion. But in my view, these models lack normative status. And I'm going to suggest an alternative response, which is tell it like it is. Some households make investment mistakes. I'm going to use the term investment mistakes to describe decisions that are inconsistent with any of the standard models we use in finance and with financial planning advice. I think we can hope that households can learn to avoid such mistakes, and at a practical level, we in the finance profession can try to combat investment mistakes. So in the remainder of this talk, I will ask 4 questions about investment mistakes. First of all, who makes them? I will show in a variety of different contexts that poorer and less educated households are more likely to make investment mistakes. And this strengthens the case for labeling these behaviors as mistakes. Second, what are the welfare costs? I will show that they are modest for many households, but substantial for some. Now, mistakes with modest welfare costs can easily be explained by small frictions that we leave out of our standard models, such as fixed costs of stock market participation. But such frictions cannot easily explain the larger mistakes made by a minority of households. I'll also argue that some mistakes may result from efforts to avoid others. We could call this the out of the frying pan into the fire principle. For example, households with limited investment skill may keep all their money in the bank, or they may pay exorbitant fees to mutual fund managers for fear that direct equity investment will be unsuccessful. Third, does financial innovation help households to limit their investment mistakes? Financial innovation is certainly important and certainly can be helpful, but I will argue that it proceeds more slowly in retail markets because of the costs of educating households. In some cases, complex financial products allow a cross-subsidy from naive to sophisticated households. This cross-subsidy can slow down financial innovation and perpetuate investment mistakes. This part of the field, which studies these issues, might be called equilibrium household finance, and it has interesting connections with modern industrial organization. Finally, what can the finance profession do to help? As a financial educator, I'm tempted to call for a vast expansion of financial education. But academic finance may have more to offer by influencing financial product design, consumer regulation, disclosure rules, and the provision of investment default options. Work on these topics might be called household financial engineering, and it offers a powerful practical rationale for the study of household finance. Now, I'll discuss these questions in the context of 3 examples. First, the failure to participate in risky asset markets, the failure to hold equity, for example. Now, this is a mistake because of the basic principle that a risk-averse agent should take at least a small amount of any positively compensated risk. Second, the failure to diversify risky asset holdings. Now, this is a mistake because undiversified portfolios take uncompensated risk that could be costlessly avoided. Third, I'll turn to the mortgage market and talk about the failure to refinance mortgages promptly when interest rates decline. I include this last mistake because the mortgage is the largest financial contract of a typical household in the United States, and mortgages are correspondingly central to the field of household finance. So let me illustrate the first mistake, the failure to participate, by showing you some data from the survey of consumer finances, which is the most widely used survey for the study of wealth in the United States. And while it has its limitations, it's certainly very suitable for looking at asset allocation decisions. So in this first chart, to warm up, I show you a picture of the wealth distribution as measured in the survey of consumer finances. The horizontal axis in this figure shows the position of a household in the wealth distribution as measured by total assets without subtracting liabilities. So at the far left we have the poorest households, at the far right we have the richest households. The vertical axis shows dollars on a log scale. The blue line shows the total assets of the household, including housing, vehicles, and all financial assets, also defined contribution pension accounts, everything really except human capital and defined benefit pension assets. The green line shows the financial piece of that, and the dashed red line shows net worth, so that line subtracts debts. Now, if we look at the median household at the 50th percentile of this distribution, it has total assets of $135,000, net worth of $86,000, and financial assets of $35,000. What that means is that the household has a house and vehicles that are worth $100,000, and it has debt of $49,000. So immediately we see the dominant importance of housing in the asset portfolio of the household, and the large size of the mortgage debt relative to financial assets or net worth. So household finance is going to be concerned with households like that in the middle of the distribution. We're going to pay the most attention to those, whereas in the field of asset pricing, what matters is wealth-weighted asset demands. So households at the far right of the picture, let's say the top decile who have assets of more than $1 million, these are the households that will dominate in asset pricing, whereas in household finance, we're looking much more at the middle of this distribution. Now, my next figure shows the participation rates in different asset classes for households, again, measured across the wealth distribution. So the horizontal axis is the same as before, but now the vertical axis shows participation rates in various asset classes. The blue line, the first one at the left, the blue line is safe assets. So this is bank account, money market fund, that kind of thing. The dashed yellow line is vehicles. And you can see that these are the first things that people acquire as they move from the extreme poverty at the far left, as they move up the wealth distribution. The first things that people acquire in this country are cash and cars. We then start to see housing playing an important role. Housing is the purple line with diamonds on it, and that becomes important around somewhere between the 20th and 30th percentile of the wealth distribution. And you can see that this is a country in which the middle class, the middle of the income distribution, overwhelmingly owns housing. The yellow line with triangles is equity, and you can see that equity participation rates increase steadily as we move up the wealth distribution, but it takes a long time for those participation rates to become extremely large. A household, for example, at the 80th percentile of the wealth distribution has $200,000 in financial assets, and 20% of those households own no public equity, either in retirement accounts or directly. Now, the final line on the figure is private businesses. That's the black dashed line. And you can see how that becomes extremely important at the upper right, at the far right of the distribution. The wealthiest households in the economy tend to be private business owners. Now, researchers such as John Heaton and Debbie Lucas have emphasized that there can be a crowding out effect of private businesses on public stock ownership. And, for example, of the 20% of households at the 80th percentile of the distribution, the 20% that don't own any public equity, about half of those own private businesses, which might be an explanation for their reluctance to hold public equity. Still, that leaves 10% of these households that own neither private nor public equity, and this behavior is hard to explain with any kind of reasonable fixed costs. It's certainly plausible that for households down at the left of the distribution, they simply don't have enough wealth to justify even very small fixed costs of equity market participation. The mystery is more the limited participation towards the right of this picture. My third figure just shows the shares of each asset class in household portfolios. Again, the horizontal axis is the same as before, but now what I'm plotting at each percentile of wealth distribution is the share of the asset class in the aggregate portfolio of households at that position in the distribution. So I'm simply treating all the households with that much wealth as if they were a single household, adding up their portfolio and calculating the share. What we see is, yet again, how cash and vehicles are the overwhelmingly important assets for households, for the poor, the bottom 20% or so. And we see the dominant role of housing for the middle class, and we see the gradually increasing role of equities as households become richer. Now, I've been arguing that the decision not to hold equity is an investment mistake, at least for households that have a significant amount of wealth. The next thing I'll show you is the result of a fairly standard exercise in this kind of literature, which is simply a regression that predicts participation. So it's a logit regression using data from this 2001 survey of consumer finances. And rather than show you regression coefficients, although you can find them in the paper, I just show you the participation rate for a reference household, which is a married white male with no high school education, but mean income and wealth. And that's 57%. So that's roughly what you'd have seen in the figure at the middle of the figure. And then I show you the estimated effect of completing high school, completing college, adding 1 standard deviation to income, and adding 1 standard deviation to wealth. And the point that I want to make here is simply that the strong effect of education on participation is supportive evidence that non-participation is an investment mistake. To quote Michael Haliassos and Carol Bertaux, who are some of the early researchers on this, education and the free acquisition of information are important in overcoming the barrier to stockholding erected by ignorance and misperceptions. All right, well, now I will turn to diversification, and I will talk about the failure to diversify. The challenge here is one of measurement. When we run surveys, household surveys, they don't generally go down to the level of individual assets. It's hard enough to get accurate answers about the broad asset allocation decisions of households. If we started asking households about every individual stock, bond, and mutual fund that they own, we would be most unlikely to get answers. Instead, they would hang up the phone. So essentially, survey data on individual asset holdings are not available. Now, an interesting alternative is to go to the financial intermediaries that provide accounts. And, for example, Terry O'Dean has pioneered the use of data from brokerage accounts. The difficulty with this is that brokerage accounts are taken from a single brokerage, and so they won't show the complete portfolio of the household, which may have holdings with other financial institutions. So what I'm going to show you, I'm going to draw on a joint project that I've been doing this year with Laurent Calvet and Paolo Sodini. And we go to Sweden, which is a country where Big Brother is watching you. Sweden has a wealth tax. And in order to levy this wealth tax, the Swedish government requires financial intermediaries of all kinds, mutual funds, banks, brokerage houses, and so forth, to report details of each citizen's asset holdings. And this is done on an annual basis. The government then aggregates the data, sends every citizen a statement each year which reports the total asset holdings and calculates the implied tax liability. The citizen has the right to challenge this and correct the records. And at the end of this process, what we have is a snapshot of each citizen's portfolio at the end of each year. So what we do with this data is we use the portfolio weights together with the estimated variance-covariance matrix of returns on all these individual stocks and mutual funds. And we combine that with an asset pricing model that derives means from second moments. We don't try to directly estimate means because those estimates would be very noisy. So we impose an asset pricing model on the data, we estimate the second moments, we combine that with the portfolio shares, and the result is that we can plot household portfolios on a mean standard deviation diagram. So this figure is taken from the paper with Calvet and Sodini. It's a familiar textbook mean standard deviation diagram, but the dots in this figure do not represent individual assets. They represent the portfolios of 10,000 randomly selected Swedish households. The plot shows 10,000 just because as you keep increasing the data set and plotting more and more households, you just cover the page in black ink and you no longer get a good picture of the distribution. The assets, by assumption, all fall on a line. We assumed that a global dollar CAPM describes the data, which implies that from a Swedish point of view, the currency hedged world index, shown in red, is the efficient portfolio with a Sharpe ratio of about 45% per year. And that hedged world index is the red dot. And then the red line is the efficient frontier, through that index. So according to the global CAPM, in which all households are holding efficient portfolios, everybody should be on that line. Well, you can see that they're not. Now, the green line and the corresponding green dot are the world index unhedged. That's to say the world index translated to Swedish krona. So you hold international stocks, but you take the currency risk from a Swedish point of view. That has, according to our model, a somewhat lower Sharpe ratio of about 33%. This strategy is what's readily available in Sweden by holding global equity mutual funds. And you can see that quite a lot of households in Sweden actually do come pretty close to that unhedged world index frontier. Finally, there's a pinkish purplish dot, which you may be able to pick out in the middle of the cloud of points, and that is the Swedish index. And you can see that, in fact, many households in Sweden do quite well relative to holding the Swedish index. This is because Sweden is a small economy. People are well aware of the need to diversify internationally, and many of the most widely held mutual funds are actually global funds. So what's the lesson of this analysis? Well, just to summarize in a very cursory way some of the results of that paper, the median Swedish household does quite well. Gets a Sharpe ratio of about a third below the hedged world index, but only about 15%, 14% below the unhedged world index, and actually beats the Swedish index. But there's a minority that does much worse. If we look at the distribution of Sharpe ratio losses or reductions in Sharpe ratio from the achievable maximum, the 95th percentile of that distribution is losing 2/3 of the Sharpe ratio relative to the hedged world index and 55% relative to the unhedged world index. In other words, giving up more than half the average return that you could get for the risk you take. And the corresponding dollar losses can be quite substantial. So when we take the vertical distance in the diagram, which is the return loss, multiplied by the portfolio size to convert to dollars, and calculate the distribution of that, at the 95th percentile of the loss, it's $1,800 a year relative to the hedged index, and $650 a year relative to the unhedged index. So there are some households that really are investing inefficiently and losing a significant amount of money each year. Now, who is it that makes this mistake? Well, without having the time to go into details, it's older, poorer, and less educated households which tend to have lower Sharpe ratios. But interestingly, these households also tend to invest more cautiously. They have lower portfolio shares in equities, and the equities that they hold tend to have lower betas. So there are actually offsetting effects on the overall return loss, and I'm going to illustrate this with a diagram. If the green line in this figure is the efficient benchmark, and I'm going to compare two households, the blue household, which is financially sophisticated and aggressive, it has a steep line, but it moves well out the steep line. And then a red household is financially unsophisticated but also cautious. It has a flat line. It's investing less efficiently, but the return loss can be smaller if it's sufficiently cautious. So this is what I call the out of the frying pan into the fire principle. The results suggest that some mistakes, some investment mistakes, may result from household efforts to avoid other mistakes. So less skillful households, which are the ones that have lower Sharpe ratios, they may take less risk, or they may avoid risky assets altogether. And in order to illustrate the effect of this, in the paper with Calvé and Sedini, we calculate the portfolio return loss for a typical non-participant in Sweden. So this is trying to calculate the welfare cost of non-participation. And if we compare non-participation with efficient investing and the total risk that's taken by a typical equity market participant in Sweden, we find a return loss of 4% per year. On the other hand, if we compare the return from non-participation with the return that will be earned by by a household that has the demographic characteristics of non-participating households, in other words, a less educated, poorer, older household, if we predict the Sharpe ratio it's going to get and the risk it's going to take, and then we compare non-participation to that, we find that the return loss is smaller, only 2.2%. So I think the point here is that there's an interesting interaction among different investment mistakes. And this doesn't mean to say that non-participation is not a mistake, merely that the cost of that mistake will vary depending on what you think the alternative is. And if you think that the alternative is inefficient, undiversified investing, then the cost of non-participation may be smaller. Similarly, if you look at the costs of paying high fees to mutual funds, what we tend to do is compare paying a high fee to a mutual fund manager with efficiently investing on your own behalf. That may not be possible for some households, and so we need to take that into account as we consider the cost of the high fee paying mistake. Now I'd like to turn to a somewhat different topic and talk about the failure to refinance mortgages. As I showed you earlier, mortgages are of overwhelming importance for middle-class households. And mortgages are actually surprisingly complex financial instruments. In the US, as you know, nominal long-term fixed-rate mortgages predominate. In a typical year, they are, on average, over the last few years, they've been about 72% of mortgage originations have been long-term nominal fixed-rate mortgages. And these mortgages carry a valuable option, an embedded option, which is the option to refinance at any time without a prepayment penalty. And it's well known in the mortgage-backed securities industry that households do not refinance optimally. Some households refinance slowly, and they pay high rates on old mortgages. Now, this is intensively studied by experts in the valuation of mortgage-backed securities, but I want to look at it from a different point of view. I want to look at it from the point of view of household finance and ask which households are the ones that are making this mistake. So I'll show you in this figure some data from the American Housing Survey, which is a survey conducted every 2 years. It's a panel data set in the sense that the interviewers go back to the same housing units every 2 years, and then over time they add more as houses get built. They aren't always interviewing the same people, of course. If people move, then the new occupant of a housing unit will be interviewed the next time around. Among the questions they ask are questions on the form, origination year, and rate on the homeowner's mortgage. And there are numerous issues with the quality of these data. One has to try to clean them up. But after doing some extensive data cleaning, which was undertaken by Ali Schwartz, a Harvard PhD student who's been working with me on this topic, the resulting mortgage rate distribution is illustrated in this figure. Now, the different colored lines represent different years of the American Housing Survey. And what I'm showing you in each case is the cumulative distribution function of the spread of the homeowner's mortgage rate relative to the currently available rate in the year of the survey. So there are some households at the left of the figure that refinanced in a previous year and got a better rate than is currently available, or at least they report a better rate than is currently available. There are other households that are paying much higher rates than is currently available. So if you look at the red, let's talk first about the red, blue, and green lines. These are years 1997, 1999, and 2001, which are years in which rates had previously been stable or gently declining. And in each of those years, about a quarter of the households were paying more than 1% above the current rate, which is the threshold level that financial planners often recommend you should refinance if you can save 1%. There are, of course, fixed costs of refinancing that you have to cover. So about a quarter of the households in those years were paying more than 1%, and about 15% of households were paying more than 2% above the current mortgage rate. Now, it's generally thought that there's been a long-term trend towards more prompt refinancing, and the randomness in that trend is called prepayment risk in the literature on mortgage-backed securities. This is certainly true, but in 2003, what you see is the effect of a sudden and substantial decline in mortgage rates. That decline created a refinancing boom in 2002 and 2003, but even so, at the time of the 2003 survey, more than half the households were paying at least 1% above the current rate, and a quarter of them were paying more than 2% above the current rate. So I haven't attempted to build a complete model of the optimal mortgage refinancing decision, but it's fairly clear that, as is well known, there is substantial sluggishness in this refinancing decision. So what I want to direct your attention to is the issue of who is it that refinances. So I'm going to show you some regression results from the American Housing Survey based on refinancing behavior in the period 2001 to 2003. In other words, during the period of declining rates, the refinancing boom, who was it that took advantage of declining rates to refinance? Once again, I'm going to show you simply a probit regression, but rather than show you the regression coefficients, I'm just going to show you the implied probabilities. The reference household, which is an average household, married white male without high school education, with average income, home value, and age, 28% of the reference households refinanced. But you can see that there are substantial effects of education on that refinancing probability. So having a high school diploma moves you up 5 percentage points from 28% to 33%. Having a college degree moves you up 9 percentage points from 28% to 37%. Similarly, income and particularly house value leads to refinancing. And age, on the other hand, older households were less likely to refinance. So I think this gives us an indication that sluggish refinancing is another example of investment mistakes. Some households simply are slower to take advantage of these opportunities than others. I should say also that the regression, the underlying regression here, controls for some of the constraints on households' ability to refinance. If your house price has declined so that you have negative home equity, or if your income has declined so that you're no longer creditworthy, you may not be able to exploit a refinancing opportunity, but the regression controls for income and house value in the appropriate way. Now, one rational reason why you might be slow to refinance is if you expect to move. Moving households are thrown out of the data set, and households that thought they would move and didn't are going to be recorded as non-refinancers. So one explanation for this might just be variations in mobility. But we can look directly at that because we can look at the cases where one household answers the survey in 2001 and another household answers in 2003. 5% of the survey of the base, for the reference household, 5% of them are confirmed moves of this type. What you can see is that education and income actually increase the probability of moving. So the mobility cannot be an explanation for the failure to refinance, because actually the households that are more likely to move are also the ones that are more likely to refinance. And again, with age, it goes the right way. Younger households are more likely to move, but younger households are also more likely to refinance. And finally, really just for amusement, after struggling with the issues of data quality, I thought perhaps we could take advantage of poor data quality. Some households state mortgage rates that are obviously wrong. And I'm going to use a pretty extreme definition of obviously wrong. Some households claim to be paying mortgage rates that are more than 2 percentage points below the lowest rate that was available in the origination year. And that doesn't sound plausible. It's, of course, true that some households may have poor credit quality and pay a very high rate, but it's hard to get an extraordinarily low rate. In the 2001 survey, 1.3% of the reference households stated these crazy rates. Education has a big effect on the probability of doing this. Far fewer educated households do this than uneducated households. Now, the relevance of this is that if you don't know what your mortgage rate is, then it's plausible that you won't refinance. You're not paying attention. And so this is perhaps a little frivolous, this evidence, but I think it's just a supporting piece of evidence. Okay, now what I'd now like to do is turn to my third question and ask, what is the role of financial innovation in helping households to avoid these investment mistakes? It's common to hear finance speeches that extol the potential of financial innovation to improve the world by moving allocations closer to the optimum achievable in complete markets with optimizing consumers. And while I agree with the general thrust of such speeches, I think that some caution is warranted when we look at retail financial markets. So the puzzle is that household investment problems are inherently complex. The decision to optimally refinance a mortgage What is that? That's the decision to exercise a real option. There are some fixed costs. You have an option. There's a threshold. To solve that problem, you have to read Dixit and Pindyke, do dynamic stochastic programming. It's a really hard problem. And yet, ordinary households are faced with these contracts that ask them to solve that problem. So it may not be surprising, given the contract, that households make investment mistakes. But why are they asked to do these complex things in the first place? Why don't easier to manage contracts evolve? So I'm going to argue that there are significant barriers to financial innovation in retail financial markets. And a first point is just there are some general barriers. It's costly to reach households. It's costly to educate them. If you have a new financial product, you're going to have to communicate to households why it is advantageous. And that's going to be a very costly proposition. The financial innovator that pays this cost is not necessarily going to be able to reap the benefit because patent protection in practice is pretty weak in financial markets generally, and certainly in the retail context. Now that's a general and obvious set of points. But I'd like to explore a more specific point, which is a barrier that can arise to simplifying financial innovation. I'm going to argue that some complex products create a cross-subsidy from naive to sophisticated households. So refinancing of mortgages is a very good example. The households that know how to refinance optimally will do so. Other households, naive or uneducated households, will fail to refinance. That provides additional mortgage interest to the lenders, and in a competitive mortgage lending market, that is reflected in a lower mortgage rate. So naive households pay too much. Sophisticated households benefit from that by getting a lower mortgage rate. Now, this cross-subsidy permits what Xavier Gebex and David Leibson have called a shrouded equilibrium. In this equilibrium, naive households won't adopt a new product because they don't understand it. Sophisticated households won't adopt a new product because if they switch to the new product, they will lose the benefit of the cross-subsidy. So, for example, if we imagine someone trying to sell an automatically refinancing mortgage, which will simply refinance by itself anytime the mortgage rate falls, say, 1% below the current rate, and it will do so without any title insurance, paperwork, any of those fees, that sounds like a great product. Why doesn't it take over? Because a sophisticated household will find it expensive. For a sophisticated household, you will lose the benefit of the cross-subsidy from the naive households. And naive households will find this new product off-putting, complicated, they don't understand it. In that situation, it can be that innovators don't gain by educating households. There would be a gain from educating all households at once. But if you're only able to reach a small fraction of households, once you educate them, they become sophisticated. Then they realize they can gain from the cross-subsidy in the existing mortgage, and they won't switch to the new mortgage either. So no private company, no innovator has any incentive to change the equilibrium. So that is all my paraphrase of Gebex and Leibson, not my original contribution. But I just want to argue that in practice, these cross-subsidy effects may be important. So in the US, fixed mortgage rates are clearly lower because of sluggish refinancing. And just as a general order of magnitude calculation, if I take that figure that I showed you from the American Housing Survey and calculate the total payments that were made in each year that exceeded the current rate plus 1%, that was 53 basis points of total mortgage value, of mortgage principal in 97, similar amounts in 99 and 2001, and over 100 basis points in 2003. Now, those numbers are just suggestive because they're realizations along a particular path of declining rates, but they do suggest that the cross-subsidy can be quantitatively significant and that this could inhibit the development of automatically refinancing or inflation-adjusted other kinds of superior mortgages. A similar effect has been noted in the UK, where the the prevailing mortgage system is very different. In the UK, adjustable rate mortgages dominate. And this has been an issue of some concern to the UK government because it's so different from the rest of Europe. And this has been a barrier to financial integration between the UK and the Eurozone. So a British economist, David Miles, was commissioned by the British Chancellor of the Exchequer to report on the state of UK mortgage finance. And the Miles report shows that these adjustable mortgages in the UK are sold with very low teaser rates being initial rates, roughly LIBOR. So there's no credit spread at all in the teaser rate. Now, if you don't refinance that mortgage, after a while, it switches you to the standard rate, which is at a very high spread to LIBOR, about 175 basis points above LIBOR. And there's no refinancing penalty. So obviously, the rational thing to do is keep borrowing at the teaser rate and pay no credit spread and get cheap mortgage borrowing. But people don't do this. Almost a third of borrowers paid the standard rate in 2003. And David Miles expresses the concern that in the UK, this structure inhibits the use of fixed-rate mortgages, which for some borrowers might have better risk management properties. So in effect, the US and the UK seem to be stuck in two different equilibria for historical reasons that I can't go into here, but for historical reasons, they're in different equilibria, and the existence of cross-subsidy in each of these equilibria may be one factor that inhibits innovation and thus inhibits convergence of the two systems. All right, so let me conclude. I had these 4 questions about investment mistakes. Who makes them? What are the welfare costs? Does financial innovation help? And how can we help? So who makes the investment mistakes? Well, it's poorer and less educated households. And I hope I've given you a glimpse of that in these 3 different contexts. What are the welfare costs? Well, they're modest for many. I don't want to say that every household is messing up. The Swedish data, for example, showed you that many households do quite well and make good use of modern financial markets. But there is a substantial minority that make substantial mistakes. And I've argued that we may want to think of these mistakes as interacting. So we may want to take an integrated view of non-participation, limited diversification, and paying high fees. Does financial innovation help? Yes, it may. Certainly information technology may be very helpful by allowing cheap customization and tailoring financial products to households' needs. But it often proceeds slowly in retail markets, and I've identified this problem of cross-subsidy. Finally, how can we help? Well, I think there's a number of ways that we can help. Financial education is certainly a good thing and will become, I believe, ever more important as in this century as we ask households to take more and more responsibility for their own retirement saving and their own long-term financial planning. And as an audience of financial educators, I'm sure you will agree with me that financial education is important. But we should be careful not to overestimate the power of education. In particular, I've shown you demographic regressions with education variables on the right-hand side, but we have to remember that those variables are endogenous. They proxy for cognitive ability and all kinds of other omitted factors. And so they may overstate the effects of exogenous changes in education on investment behavior. So I think there's some other things we can look at. Now, you might think that regulation to prohibit predatory lending and excessive cross-subsidy might be helpful, but we have to be very careful because it's difficult to design regulations that protect naive households without also inhibiting helpful innovation. For example, regulations to prevent negative amortization in mortgage contracts, which are intended to protect households from running up excessive debts, actually prevent the inflation adjustment of principal if amortization is defined in nominal terms. So it's easy for regulation to backfire. Disclosure requirements can be helpful, but they have to be designed appropriately. So a nice example is in the Miles report on UK mortgage finance. David Miles points out that in the UK, there's required disclosure of the annual percentage rate, or APR, on a mortgage. And this is the main cost measure that borrowers look at. But it's calculated under the assumption that interest rates will remain unchanged during the life of the mortgage. Now, when the yield curve is steeply upward sloping, that assumption is going to make an adjustable rate mortgage look like a good deal, because it assumes flat interest rates when the bond market thinks interest rates are going to rise. So Miles makes the very sensible recommendation that the APR should be calculated using forward rates to proxy for future spot rates. Finally, recent research in behavioral finance has emphasized the important role that default options can play. Default options meaning standard choices that households believe to be recommended by authoritative bodies. And these seem to have a powerful effect on household behavior. In mortgages, for example, the US government plays a major indirect role through its agency, Ginnie Mae, and through its sponsored agencies, Fannie Mae and Freddie Mac. And these organizations have traditionally favored nominal fixed-rate mortgages, and this is part of the reason for the dominance of those mortgages in the United States. So it's plausible to think that they might be able to encourage the use of mortgages with innovative features. So this whole area of thinking through product design, default options, disclosures, I'll slap on the label of household financial engineering and suggest that it gives us an inspiring possibility that household finance may be able to improve welfare. John Maynard Keynes wrote in 1932 that he looked forward to a distant future time when economists would be thought of as humble, competent people on a level with dentists. Now, today, dentists spend much of their time delivering advice and easy-to-use products that promote oral hygiene. And I think economists, for our part, can deliver, or at least design, advice and innovations to promote financial hygiene. Thank you.